Hello, this is Coach, or otherwise known as Dr. Spellman, here to talk to you about valuation. This is a critically important subject. If you don't understand how to value security, you could very well buy a stock that you think will be good, and you find out it is not good. Too many people buy, sell, and hold securities and pay a price without really understanding what that price reflects. I want to help you understand what that price reflects here in this video. We'll be actually talking about both the theoretical underpinnings of valuation, specifically looking at multiples such as the PE ratio, and then showing how to use these multiples in practice with real examples. So let's get right into this. So first, before we're going through valuation, let me remind you what I call the investment process. All the different things we can do as an investment manager or an individual to analyze the markets and add value. So in the blue area is the types of analyses we can do, and we start on the left. Let's say we are great at analyzing the economy. Well, being great at analyzing the economy is very difficult. Why? Because there's many different variables we actually have to think about in order to get the economy right. But it's very highly value added. And the reason why forecasting a direction of the economy is value added is because it helps lead to your decision on which asset class to be in. If you think the economy is going to do really well, you would expect stocks to outperform bonds, and that can add a lot of value to your returns. The economy also influences styles of investing quite a bit, large versus small stocks, value versus growth, quality, not quality, and that can add a lot of value. It can also add a lot of value to help you get in the right sectors. Some sectors have way more sensitivity to the economy than other sectors. And the ones that are more sensitive to the economy tend to do better when the economy is strong, and the ones that are not sensitive to the economy, such as consumer staples, tend to do better versus the market when the economy is not so strong. So the economy is very important to getting these three calls correct, and they can add a lot of value added to your returns. Now, what is this industry versus a sector? Well, a sector is one of the broader category of securities. So an industry within technology sector would be like software, and another industry within technology would be hardware. As you move to the right, the types of analysis are less influenced by the economy and more influenced by idiosyncratic fundamentals, okay? The economy is still very important though. Once we get down to company analysis, and we're focusing on the valuation part of company analysis in this slide deck, in this presentation, we're really trying to pick out the best companies within an industry. Now that's assuming that you're properly diversified across the asset classes, styles, sector. If you are properly diversified here on these areas, then getting the company call right is very important to buying the right securities within industries. And how do you get the company call right? I like to divide what you do for company analysis into three different components. One is you have to understand the business dynamics of the firm. That would be like products, markets, management. You could have a great business, but not be a good stock. But you could have a great business and be a good stock as well. A lot of that comes out to how the security is valued. So let's say you have a great business, good products, markets, and it's strong financially. What do I mean by strong financially? It's producing really good free cash flow, has good margins, very good growth. So you could have a great business that has great financials and still not be a good stock if it's priced for perfection. Price for perfection, by the way, is better than great. And if you're priced for perfection and it's better than great, more than likely you're going to miss the expectations because you're going to produce great results instead of perfect results. And if you miss the expectation, even producing great results you're going to disappoint investors and the stock could go down. So valuation, ultimately, if you have at least a longer term horizon, is really going to be something that is very important to understand in order to get the stock call right. And that's the subject of our discussion today. We also have, in the process of investing, understanding trading, also understanding performance, and underperformance, also risk. And this is still value added, it's still difficult, it's very complex to calculate performance and risk. But if you do not know where your performance is coming from, then you may actually think that I just have bad stocks when it's something else that's causing you to do poorly. And so if you don't understand where the performance is coming from, you may actually say, you know what, I have bad stocks. Stocks could be good. Maybe you're just in the wrong sector. And it could cause you to sell those stocks at the wrong time. So understanding where your performance is coming from and where the risk in the portfolio are coming from is very important to keeping you on the right direction and not taking risks that are unattended. Right, so this is the process. The rest of our slide deck and presentation here is focused on valuation, but valuation follows through from the business and financial, so we'll also be talking about that. So, steps in the valuation. There's 4 steps to valuing a stock. The first one, as we said before, last slide, we have to understand the key industry and business drivers. Those drivers will produce financials. And financial statements really just quantify what's happening in the business and industry. Bring these 2 things together. You value the security using a number of approaches. I separate the approaches into 2 main categories, using multiples or relative value and absolute value or intrinsic worth. What I say by multiples, that would be like using a PE ratio. And you can actually use a PE, price divided by earnings, as a ratio to compare your company to other companies, which means you're comparing your company on a relative basis to other companies with different P's. You can also look at that PE over time, compare today's PE to what it's been in the past. So it's also looking at how you are doing relative to the past. So that's the reason why I call it relative value. You could also say, what is this company worth? If the company is worth 60 and the stock's trading at 50, when the stock's trading below its worth, and maybe it's a good deal and you should buy it. So that's what we mean by make conclusions. Understand what the price is, and as the price is lower than the value, that may be a buy, dependent upon how confident you are in your assumptions and how much different the price is than the value. So let me give you an example of these valuation methods. Now, my example here is on gold and it's on oil. Gold and oil are actually 2 assets that are very, very hard to value. So if I can convince you on gold and oil, then I should be able to convince you on using these approaches for anything else. Okay, so this is my attempt to show you how you use relative value and absolute value to value the assets of gold and oil, 2 very difficult to value assets. So first of all, looking at multiples and relative value. So what I'm going to do here, I'm going to look at what gold and oil are worth relative to each other. Then I'm going to look at how they're relative to each other over their history. That's what I have on the graph on the right. What I've calculated is how many barrels of oil you can buy per ounce of gold. So if gold's at $1,200 and oil costs $100 a barrel, then you could buy 12 barrels of oil with every ounce of gold. So you can actually track the ratio, how many barrels of oil you can buy per ounce of gold over time. So this is using a history. And barrels of oil per ounce of gold is just a multiple, so it's a relative value, oil to gold. What you actually see right now is that you can buy, it looks like here is between 15 and 20, about 17 barrels of oil per ounce of gold. Back here in 2015-16, when oil prices really fell, you actually got a better deal. If you're own gold, you could buy more ounces of uh, oil per ounce of gold, which means oil was really cheap relative to gold back here. But as oil prices have risen, and they've risen more than gold prices have risen, now you can't get as many barrels of oil per ounce of gold. So oil has become relatively more expensive than gold over this period of time, just because oil has gone up at a quicker pace than gold. Or gold may not have gone up at all, but oil did. Now, if you look at this ratio versus its whole history, right now we can still buy, it looks like the 17 is a little bit above average, just barely above average. So I can get a little bit extra ounces of, barrels of oil per ounce of gold than normally over this, going back to 1994. So that would say to you, on a relative basis, that oil is still slightly cheap versus gold, or gold is still slightly expensive versus oil. Now, you can use this relative value and the history of it, assuming that the history is going to go forward in the future. Because when we value a security, we're really trying to figure out what's going to happen in the future. But we can use the history as a starting point. Now, gold and oil, maybe the past is representative of the future, maybe it's not, but probably is a little bit more representative in the future than two companies, if I did this for one company to another, because companies can move through a life cycle and they can be very different in the future than they were in the past. So be careful of using a relative value to the history if the two assets are changing over time. All right, so that's relative value and relative value history. Now let's actually just think about the absolute underlying worth of gold and oil, okay? So what I actually have here is gold prices over time, which is the blue line, and the black is oil prices over time, but on an absolute basis. So as you can see, oil has risen here quite a bit from its depths back in 2015 to about $80 per barrel. Gold, on the other hand, has risen a little bit over that period of time, but still is about flattish between $1,200 to $13 an ounce. On an absolute basis, oil's become more expensive. On an absolute basis, gold hasn't done anything since, well, about 2011. Now, how do we value a stock on an absolute basis? Generally, we're discounting cash flows which happen in the future back to today, or we're using some residual income approach. Gold and oil is a little bit more difficult because they're not necessarily the asset, the commodity is not producing cash flows for you, but you can still value them on an absolute basis. Here's one example of a way to do it. Let's say gold takes $1,200 costs to get it out of the ground. Well, if that's the case, you would expect gold not to fall much below $1,200 an ounce, because if gold fell below $1,200 an ounce, the miners would stop mining gold because they lose money. And if they stop mining gold, the supply of gold would dry up and the supply would become less than demand. And if the supply is less demand, it would bid the price back up to, again, above $1,200. So there is probably some absolute underlying worth of both oil and gold based on their cost structure. Now, earlier, I told you that the valuation follows from understanding the business and financial health. And I also said the economy is actually very important to understanding the value of the assets. Gold and oil are no exceptions to this. So let me actually show you that relationship. So I have moved this blue line here to the blue down here. And on this graph, I've also added the black. And the black is the ISM PMI, so the Institute of Supply Chain Management's Purchasing Managers Index. If the PMI is above 50, that means we have growth. If the PMI is going up, that means the growth is improving, it's accelerating. If the PMI is below 50, the survey of manufacturers, that says things are shrinking. And if the PMI is going down, that means it's shrinking and it's getting worse. You notice that there's an inverse relationship between the black, which is a gauge of the economy, and the blue, which is the relative value between oil and gold. Let's look at the financial crisis. So the economy was getting, well, first of all, it was shrinking under 50, and it was getting worse. Well, when the economy is shrinking and getting worse, you would expect assets that have a store of value to do very well in that environment. And what you see here is that gold versus oil went way up. Going back here, you see gold was somewhat flattish, a little bit went up when oil prices fell, which created this huge spike. So gold outperformed oil in times of crises. However, gold underperformed oil because you could buy less barrels of oil with gold back here in 2001 to 2005 as the economy took off. So the economic well-being very much is important to driving the relative value of gold versus oil. Great. That hopefully convinced you that this evaluation stuff is important and it changes over time with a driver. In this particular case, the driver was the economy. So valuation matters. The return of a stock is a function of earnings growth, yield, and changes in PE. Price is just PE times E. Price divided by earnings times earnings divided by 1 gives you price. Earnings in the numerator cancels with earnings in the denominator. And also, by the way, change in price is just 1 plus the percent change in PE times 1 plus percent change in earnings minus 1. So valuation, this multiple PE, is very much a component of determining price. We have the price of the S&P 500 here over time, going back many, many years. Over here, I actually show you the price return on an annual basis. So basically, I'm taking the annual change in this black line and making this the black here, and showing you how much of this annual change in price is determined based on earnings and how much is based on changes in PE. Earnings is in the blue bars, and PE change is in the gray bars. What I want you to observe from this graph is the gray bars are about as big as the blue bars. So if you only focused on earnings, the blue, you're missing about half the story. Valuation is very critical to determining the returns of the stock. You cannot miss this if you want to be able to project the returns. And PEs do change a lot over time. We're going to be talking a little later about what drives changes in PE, what creates a PE. So a good friend of mine, Tobias Levkovich, he's strategist at Citigroup, also gives us another example that valuation is inversely correlated with returns, which basically says here, if it's cheap, future returns are high. If it's expensive, future returns tend to be low. He created a capital goods valuation model. The components of his model include ratios such as price to EBITDA, price to book, price to sales, and a few other things. That's the red line here. Now the red line goes all the way to the right on the axis. The gray is relative returns of capital goods to the market. The gray doesn't come all the way to the right. And what he's done is he lags returns with the valuation in order to show that valuation comes before the returns. So where you are in the valuation cycle helps you forecast what future returns will be. Let's give you an example. Back here in 2009, this is again crisis situation, valuation of capital goods, the industrial economy, was very, very low. Why was it low? Well, the media is probably coming out and saying we have some huge crises. These companies are not doing very well. You're not going to build new roads and mine all this stuff, which is basically their clients of capital goods. You're not going to build lots of new airplanes, which maybe they sell into the aerospace industry, at least commercial aerospace. So basically, conditions were probably very poor at this time for capital goods. And people sold these stocks, so valuations became extremely low. But that was the time to buy, because when everybody's negative and valuation's low, the value says people expect that conditions to continue to be bad, and if there's some reversion to mean, which means the economy gets better, then capital goods business will get better, and you bought it cheaply. If you bought it cheaply and the business gets better, you have good growth because the business is getting better, and you bought it cheaply, so this PE multiple or his multiples can improve. You're going to have great returns in the future. So low valuations probably happens when times are bad, but times get better and the multiples go up, which leads to really great returns. Now let's consider the time before. Valuation was very high here, probably in the media and the news. We're talking about how great the economy is, but economy doesn't always stay great, and there could be reversion and negative, but you're paying a high multiple. They missed the signs of the contraction, the bad times to come, because they priced in the good times continuing to be really great. Well, conditions got worse and you paid a whole high price for it, and what happens is your returns are poor then. So valuation tends to be inversely correlated with future returns. When you're paying low, the future returns tend to be good. When you're paying really high, future returns tend to be low. Don't miss understanding valuation, because if you do, you may suffer having poor investment returns. I focused a lot on valuation on the last slide, but I also want to point out that price is earnings times PE. So this earnings thing is also very important. Let's look at Kohl's. Kohl's, for people who live in Wisconsin, Kohl's is headquartered in Wisconsin. I'm sure you know this company. Anyone in the United States has probably ran into a Kohl's department store. For anyone watching who hasn't seen Kohl's before, Kohl's is a department store. It's a retailer. They sell women's clothing, they sell men's clothing, they sell jewelry, they sell household products, and they're generally located in retail shopping centers near malls. They have their own building. Well, Kohl's was a phenomenal stock in 1992 through about 2001. Over that period of time when it was a phenomenal stock, the price went up, earnings just exploded, the blue line. So earnings growth is very much related to the price return over this period of time. So high earnings growth should be accompanied with good price return. But the future is also heavily dependent upon whether you pay too much for those earnings. So let's take a look at the next 12 years after this 2001 period. Earnings continue to go up, the blue line here. However, after they built out all their stores, they're all the way across the United States, and they were still building on in here. But over time, they saturated the market. They become more of a mature company. If they become more of a mature company and they're just not growing earnings for building out stores, they're going to be more impacted by the economy. And what you see here is during a recession, their earnings kind of stagnated, went down a little bit. This is the financial crisis, earnings going down. Earnings are still were on a general upward trend over that period of time, but as it matured, it became a little bit more cyclical. And now earnings are actually flattening out, probably because of the internet retailer and them completely building out their store base across the country. But over this whole period of time, about 12 years, earnings went from what, $1 to $1.50 a share to $4 a share. So the earnings tripled. But the stock went from 70 to 50 or so. The stock went nowhere, even though the earnings went up. So why did that happen? It's because the PE at the starting point in 2001, which is the ending point here, was like 55. The price to earnings ratio reflected this great growth come. It was already priced in. So even though you had this great growth, earnings went up, PE fell all the way to, looks like about 10 at one point. The PE fade more than offset the earnings growth, and the stock was a lousy stock. Even though the business dynamics associated with the earnings were great. So valuation does matter. Now, the stock had a huge PE up here too, and it continued to, well, it flattened out around 1999, but it probably was expensive up in here, and the stock continued to go up. So valuation, just because it's high this year, does not necessarily mean the stock's not going to do well if the market continues to be fooled and not really consider valuation. So Keynes, I think, had a quote, "The market can stay irrational longer than you or I can stay solvent." So keep in mind, markets have momentum. Valuation matters. It may not matter in the short term, but I would say it probably does matter quite a bit in the long term. So we're going to be using Kohl's for a lot of our examples going forward. As I pointed out with the Kohl's example, a good company is not necessarily a good security. It depends on how it's priced. But I believe every security is a buy at the right price. What's the right price? It's a price below its intrinsic worth. So if our intrinsic worth is the black line going up, and the blue line is the price, you see it's kind of goes up and down, market's kind of crazy. Where you want to actually buy the stock is when the price is lower than its intrinsic value. And this is a nice company because intrinsic worth is actually going up over time. And you want to sell when the stock is above the intrinsic value. Now, how far below the intrinsic value would I want price before I'd actually say I buy it? Well, it depends on my confidence in my estimates. It depends on the volatility of the security. If I have a really stable business, such as utilities or maybe even consumer staples, where I can forecast out earnings and cash flow with great certainty, possibly for a utility company, 10% upside would be enough. But for most companies, I wouldn't buy a stock unless there's at least 20% upside. I can be wrong on my estimates. And for portfolios that only have 30, 40 names, you would think that every company should have at least 20% upside to be a buy. Remember what Warren Buffett says, price is what you pay, value is what you get. And when do you get great value, which is above price? Generally, you get that when times are not good, during an economic crisis. But performance can reverse. Warren Buffett, I believe I read an article recently, he has over 100 billion sitting in cash. During the financial crisis, he also had a lot of cash going into that financial crisis, and he managed to place investments in some quality companies at really good deals for the stock, or really good deals for the interest he was actually getting on the preferred stock or the bonds. A couple examples are Harley Davidson and Goldman Sachs. So goal of a firm is to create intrinsic value. I say this is a goal of the firm. It's not all the goals, but I think the other goals, which are, taking care of society, taking care of your employees, being good to the environment, all these other things, if you do these other things, you'll probably also create intrinsic worth or value for your shareholders. So an asset's value is just the sum of the future expected free cash flows when converted to today's dollars. So our value equation, our intrinsic value equation, is just value equals free cash flows in the future. Each free cash flow is divided by 1 plus K, the cost of equity, to the appropriate power, which reflects the year. You can increase the value of the company by a few ways. Reducing the risk of the company so the K goes down. Growing the cash flows quicker, which means you have way high future cash flows in the numerator out here. And getting your cash flows earlier helps create more value. So if you have a whole bunch of cash flows in year one cash flow is divided by 1 plus K to the 1 power. Where if that whole bunch of cash flows happens in year 2 instead of year 1, so it's 1 year later, you have to discount it back 1 plus K to the squared. So since this denominator makes the equation smaller because it's squared versus 1, you want your cash flows earlier. So to create value, you want to reduce your risk, increase your growth rate, and have a heck of a lot of cash flows early. This equation here will convert it later to create a PE multiple. It's a great equation in finance to value securities. If instead of using free cash flow, which we have in this equation here, we use dividends instead of free cash flow, then we have the dividend discount model. I say this model is theoretically sound. However, there is lots of problems with it, which we'll be talking about, and we'll also be talking about solutions. The reason why I say this is theoretically sound, because ultimately dividends are what investors receive for owning stock. The stock should go up, holding interest rates, risk, and other factors constant as the dividends per share increase. Dividends are received in the future, so they must be discounted back today to determine their value. The dividend discount model, which is essentially this model, just using dividends, shows us how they actually value a security. That dividend discount model requires 3 inputs. 1, we have to estimate future cash flows, which include dividends, and if we don't project dividends out to the period of infinity, we also have to project price at some point of time in the future, which is cash flow. We have to predict dividend growth. We also have to predict the required return on equity or cost to equity to discount these dividends back to today. This sounds pretty simple. We have 3 different equations for the DDM, the dividend discount model, in order to do this. The first equation, 1, looks exactly like the equation I showed you a couple slides ago, except I substitute dividends for free cash flow. The nifty thing about this equation is that if you simplify this equation, you see that you have the same growth rate. So D2 is just D1 times 1 plus the growth rate, and D3 is just D2 times 1 plus the same growth rate we had in this year, and to infinity. And D3 is also D1 times 1 plus the growth rate squared. So you get the same growth rate. If that's the case, then this equation simplifies to just this equation. So all you need to know in order to calculate value is dividends over the last year times 1 plus the growth rate. That gives you dividends in the first year divided by the cost of equity minus the growth rate. Now, this is the equation. It's called the Gordon growth model, the constant growth model, the infinite period model, has many names. It's quite nifty. So it's one of the advantages of this equation is if you have the same growth rate, you can come right to here. Now, if you don't have the same growth rate, it could take you an awful long time if you did this by hand in order to calculate value, because remember, this goes to infinity, and that's a long time. Now, what if growth rate is not constant? Well, let's say you have a period where you have various growth rates to period N, because the company is going through some transition. You can actually take and actually have a two-stage model where you actually forecast dividends out each year to period N, discount them value by 1 plus k to the appropriate power, and then you actually have a second period where you assume growth is constant. Now, to get to Pn, the price at this period, you can just use this formula. So let's say Pn is year 5. So to get the price, what it's worth, the terminal value at year 5, you would actually figure out dividends in year 6, because this is year 5 plus 1, year 6 divided by k minus g, that would give you the terminal value. These are really great, really nice equations if they worked well in practice and if they didn't have a whole bunch of flaws. This is what we tend to teach in the basic intro textbooks, which is great because we want to teach the intro theory there. I'm going to show you some of the flaws to these models and show you the solutions to deal with them. Okay, so I said the theoretical intrinsic value Gordon growth model, DDM, dividend discount model, constant growth, is poor in practice. You cannot use this formula in practice and have a lot of success at picking stocks for the most part, for the great most part. So what's wrong with this? Well, first of all, I have to actually apologize a little bit. My first name is Gordon, so I apologize for this model. However, I did not create this model. So what are the problems? Few firms, possibly only utilities, pay out as much dividends as they can. So if few firms pay out as much dividend as you can, and you use this model, you're going to be using a dividends that's less than their ability to pay dividends, and your value is going to be understated. That's the first thing. The second thing is small changes in estimates lead to widely varying price targets. So if we change the estimates for cost, equity, and growth a little, this number can be a really small number and get even smaller. What I'll show you is that the value changes a lot. So I can just tweak my estimates to get whatever value I want to have. That's not a good model. No companies grow at the same rate forever. I'll show you that. So using that single stage Gordon growth model, constant growth model, infinite period model doesn't really work because you don't have a constant rate of growth. As a result, no one uses that single stage model. And even the multi-period model, where I showed you, talked about the terminal value, the PN, that model is also flawed if you're using the Gordon growth model to calculate PN. So I need to actually show you some of these problems now and also need to show you the solutions. So to get rid of the problems of dividends, companies not paying out as much dividends as they can, we need to use a different number instead of dividends in the numerator. So some companies do not pay dividends, so that model doesn't work. Other companies don't pay as much dividends as it's capable of. And the reason why they don't is because they never want to cut the dividend. Cut the dividend, you lose a job as a CEO, CFO. So they generally underpay what dividends they can pay with the earnings because they never want to cut it. And what they may do instead of paying a dividends, just buy back shares, return money to shareholders through share buybacks, but they're not counted as dividends. So the DDM understates its value. So what we can use instead of dividends in the numerator of the Gordon Growth constant dividend model is just use free cash flow to equity. Free cash flow to equity measures your ability to pay dividends because free cash flow to equity is money that's left over after, so it's free cash flow to equity is net income minus investments in working capital and fixed assets like plant and equipment or Kohl's new stores or revamping their stores. Free cash flow is what's left over after growing the business that can be used to pay dividends. Now, the official definition of free cash flow would also include changes in debt, and you would add that back. If you're growing debt, that can actually accrue to the shareholders, because if you actually add debt to grow the company, then your net income in the futures may be higher. If your net income in the future is higher, you can use some of that to pay shareholders. This is the kind of official definition of free cash flow to equity. I often like to drop off changes in debt because, well, it would need another video, another class session, but changes in debt are very lumpy. And it turns out if you reduce debt because you have a lot of cash flow, this becomes a negative. And if this becomes a negative, then your official free cash flow to equity definition becomes low. And that's kind of weird if you're discounting that. The only reason why you paid off debt is you had a lot of free cash flow. I often just like to leave off debt and just think of free cash flow to equity as net income minus my investments, and it's what's left over. Well, what's left over is value added, because if you have good free cash flow, you can buy back shares, you can pay a dividends, and if you buy back shares and you pay a dividends, that brings money back to investors, and they have that money, then they can go invest it in the stock market and even make higher returns because they have more investments. That's value added. The other things you can do with free cash flow equity is, well, you could pay off your debt. If you pay off your debt, that may reduce the risk. If you reduce the risk of your company, that can increase value. If you have way extra free cash flow, even after investing in the company, well, that may mean you can even, and paying a dividend and buying back shares and paying off debt, that may mean you can even grow more. If you grow more and you do it well, you grow more through capital investments, which is the fixed investments, and strategic acquisitions, which would be buying, working capital and new assets. So if you have extra cash flow and you can even grow more than you did before, you could get more net income in the future. If you have more net income in the future, then of course you can have higher free cash flow, and you can even pay more dividends. So free cash flow, if it's really high, can be used for all kinds of value enhancing things. So it makes sense that we can use free cash flow instead of dividends in our value equation. So instead of using dividends in the dividend discount model, use free cash flow in that dividend discount model. That's a fine idea. Let's now start talking about Kohl's and just focusing on these models using Kohl's as our example. And we're using pretty much real data for the company through these examples. So as I said earlier, for the dividend discount model, we need to forecast dividends, we need to forecast cost equity, we need to forecast growth. So, but I also said that we really don't want to use dividends because companies underpay their dividends. And in Kohl's case, they pay a dividend, but they also buy back a lot of shares. So if I just use dividends, I would be ignoring some money that Kohl's is returning to shareholders. So let's actually use free cash flow to equity. So I've forecasted free cash flow to equity for Kohl's. I'll show you my forecast in a minute. Let's assume Kohl's cost to equity is 11% using the capital asset pricing model, which is right here. I'm assuming the risk-free rate is around 3%. Right now it's trading at just under 3%. I'm assuming the beta is 1.15, so the company has about 15% more risk than the market. I say a warning here. I don't want you, if you're using beta, just to use what you look up in Yahoo Finance or someplace else. Beta for companies change over time. Beta is just a regression of equation to stock returns to the market returns. And that regression, the slope of that regression can change quite a bit for even a single company over a year's time period. So if you use beta for the individual company that's calculated for that in your equation of cost of equity, it could be a number that really doesn't work very well because it's just reflecting an outlier event. So what I like to do instead is I like to look at the industry average beta. So the outliers high and low kind of cancel out. And then say, let's say the industry average beta for retailers is 1.2. And then you actually then say, is my company more or less risky than the average company? I'd actually say that Kohl's is probably more risky than the market, but less risky than the average company. I'll show you later, they've been really great at distributing capital and understanding that their growth rate has slowed over time, and I would like to give them a little bit of credit for that. This industry is still going through a period of time where they're being attacked by online, Amazon, so I believe they have more risk than the market. So a beta of greater than 1 is warranted. So I use 1.15. My growth rate that I'm using long-term for the company is 1%. Again, they're being attacked by online. I'll show you data later that Kohl's growth rate is a little bit lower than this, but you could make some arguments the growth could be higher than 1%. You can make arguments that growth could be lower than 1%. I'm using 1% because I know they're buying back a lot of shares, and if their environment stabilizes as they actually grow out their online business, maybe they can get to 1% growth over the long term. Using these assumptions, let's see what they're worth in that Gordon growth model, constant growth, dividend growth model using free cash flow. That's what I have here. So I forecasted 2019 and 2020 free cash flow to equity as 547 and 489. I expect the long-term growth rate of 1%, cost of equity capital 11%. What is the value of the stock at the beginning of 2019 and the beginning of 2020? Using the single stage model, but instead of dividends, using free cash flow to equity, I come up with a $55 value at the beginning of fiscal 19 and about a $49 value at the beginning of 2020. 547, just so you know, this is the beginning of fiscal year 19. I use next year's free cash flow, which is 2019 free cash flow, 547. I discount that at my K is 11%. I subtract my 1% growth rate. I give a $55 value. The next year I do the same thing and get a $49 value. My value is actually going down over time using this model. Why is my value going down? Because my cash flows are going down. Remember, we said cash flows are value added. This cash flow shows your ability to pay dividends. My ability to pay dividends and buy back shares is going down based on my model. So as a result, my stock value goes down, and it goes down exactly the amount that 10.7% that the cash flow went down. So this is a very nifty model, assuming one single stage 1% growth every year and the same cost of equity every year. And these are the values that fall out of it. But I said this model is difficult. So we solved one thing in the single stage model by using free cash flow instead of dividends, but we're also assuming the same growth rate every year, so that's another problem. And another problem is if I change these assumptions just a little bit, I'm going to get a much different valuation. So let me give you the scenarios. So we had on the prior slide about a $55 value for a 1% growth rate. I could make an argument that the growth rate is not 1%, but it's 3% because this company is buying back a lot of shares. Even if their sales and earnings are not going up, they're buying back so many shares, you probably could go from 1% to 3% and make a reasonable argument of that. Well, if I made that argument, the value would go from 55 to 70, a quite different valuation. Right now, I'm also using 11% cost of equity capital. If I really believe this company is a great allocator of capital and their environment has stabilized, maybe I should use a 1 beta and a 10% cost equity capital. If I do that, I get about a $6 improvement in value. A $6 improvement in value here and a $16 improvement value there, that's $22 on a $54 initial value of stock. That's a 40% variation and valuation with just a tiny little changes in assumptions. This model, the single stage Gordon growth model, is highly sensitive to small changes in assumptions. In this particular case, it's not even a reasonable case because this 11% and the 1% are very far apart. Let's think of a stock that is growing very quickly. Let's say we have a different stock where I'm using 11% cost of equity, but it's an 8% grower. Well, 11 minus 8 gives you 0.03. So I have to multiply $5 here by 33. So this would give me a $165 value stock. Now, in that particular company, I said it's growing 8%. If I come up with a reason to think it grows 9%, now the difference between 11 and 9 is 2.02. So I have to multiply this 5 by 50. It goes up to $250 from $165 with just 1% change in growth. This model is so sensitive when you have high growth rates to small changes in assumptions that it really doesn't work because I could justify anything practically. When I say justify anything, I could just tweak my assumptions to where the value that falls out of the model is above the price of the stock. It's not a good model. That model also assumes constant rate of growth forever. So let's talk about some stocks that are in the news that people actually think are really great growth stocks, the FANG stocks. Facebook, Apple, Amazon, Netflix, and Google. Very few, very few companies grow at a constant rate forever. I didn't say none just because maybe there is one company in the history of companies that grew at the constant rate forever. I assume that that's being generous. Very few companies, no companies, grow at a constant rate forever. And very few companies also grow at a high growth rate forever. So using a constant growth model, and certainly if the growth is high, is very unreasonable. So let's look at Facebook. Look at how the growth has slowed over time. 180% growth. We're still actually growing between 40 and 50%. Apple started with negative growth, went to positive growth, went to negative growth, had a great period of time where you're growing, let's say 20 to 60%. And then it slipped to negative as basically what happened is the smartphone market matured. And now we're going back to positive growth. Amazon started at 300, is now all the way down to maybe 25% approximately. Netflix, again, has slowed greatly over time. Google's slowed greatly over time. So constant growth and high growth, really high growth, doesn't even last for some of the companies that people are really excited about in the markets right now. Growth estimates, people's estimates of growth tend to be inflated over time. A huge warning. If you go to Yahoo Finance and you say, this is what people's expectations for growth are, and it's 10%, more than likely that growth estimate is too optimistic. So what I give here is a study by the CFA Institute This line here is growth of GDP over time. This black line here is analysts' expected growth rate for companies. In 2008, it was approximately twice the expected growth was twice what actual GDP growth was. Now you say, wait a second, these are stocks. These stock earnings and sales grow quicker than the overall economy. Well, that's not really true. Maybe for the last 20 years, if the economy has grown at 5%, earnings per share, sales per share have maybe grown at 6% approximately. I've done this math in the past. That's what I recall, maybe not quite accurate, but possibly over the last 20 years, the stock market's grown a tiny bit quicker than the economy, but not much. And I've also seen studies over time that says the stock market sales and earnings grow at the same rate as the economy. So the fact that the estimates are twice as great as the economy means they're too high. My rule of thumb, unless I'm following a utility company where people tend to know these companies are slow growers and use more reasonable growth estimates in general, I normally take whatever people are predicting and I multiply it by 60% or 2/3 and I get to a more reasonable assumption. Why is that a reasonable assumption for a long-term growth? This is a McKinsey study. They segmented companies into quintiles, the 20% growers, revenue, and all the way to the less than 5% growers based on year zero. You see there's 5 different lines here. And they then tracked what was their growth rate after a certain number of years of forming a portfolio. As you can see, this plus 20% grower or higher slowed significantly and quickly. By year 4, they reverted to the mean a lot. And the low grower company improved. By year 10, you could practically not see a differential between the initial high grower and the low grower. Yet a lot of people will forecast growth to last much longer than 4 years and even longer than 10 years. If you work out the math of what a 50 PE multiple is, which many of the FANG stocks are pricing in more than a 50 PE multiple, you'll find that their above average growth has to last very long. I do that math actually in the appendices of these slides, which are on coach investing. So you can actually look at the math. But I do a different example in the slideshow for you for later on with a high PE company versus a low PE company, what that reflects. So high growth tends to revert pretty quickly. And the future growth rate tends to be about the same depending on no matter what bucket you're in. So McKinsey also looked at a series of companies in 94 to 97, and they segmented the companies minus, less than 5% all the way to greater than 15% growers. And then they tracked what the performance was 7 years later for 3 years. So 97 to 2004, 7 years later, they looked at this 3-year growth rate versus this 3-year growth rate. If you're in a greater than a 15% growth bucket in the past, what was your future growth? Well, more than likely, you ended up in the 5 to 10% bucket and a 10 to 15% bucket. Sometimes you ended up in the really low bucket. But this kind of averages growth bucket, the 20% or even above average, 10 to 15%, that happened about 31% of the time for these really high growers in the past. How about the lower grower in the past? They had about 30% of their sample falling into these buckets. 30% for the low growers, 31% for the high growers. There's a lot of reversion to the mean. It's a good McKinsey study. There's also a really good strategist, quantitative analyst on Wall Street. His name is Michael Goldstein, and also looked at how quickly reversion actually happens. So this is one of my favorite studies that he did. He segmented companies over a very long period of time into growth firms and not growth firms. And in any given year, he had about 1,500 companies. And in any given year, he found out about 370 of those 1,500 companies got the growth status. I believe he looked at things that segment companies into growth status. I believe it was ROE and growth rates. So about a quarter of the companies, 20%, a quarter of companies in any one year, he said, were growth. Now, how long did they maintain that growth status? That's what we see in this chart. I recreated the chart from this paper. After 1 year after being in the growth status, only 85% of the companies are still in the universe. After 4 years, you have less than half of the companies, and these were the top quarter companies that managed to stay in the top quarter. Companies do not continue with growth nearly as long as people expect, yet people will often pay up really high PEs for those companies and then be disappointed. So this growth status tends to be short-lived. The average is about 4 years, less than 1/5 maintain it for a decade. Only 12 companies maintain that growth status for all 35 years. So why do companies get worse and why do companies get better? Why does growth status go away? Well, if you're a good company, you have higher ROE, high return on capital, high margins, guess what? The competition will say, I want some of that. So think of Apple when they came out with the smartphone. They're the only ones. They had huge growth, huge margins, huge profitability. That attracted competition, Samsung, etc. That competition takes away their growth opportunities. And if you have really high growth, eventually products mature. Everybody has a smartphone now. That's why a few slides ago, you see that Apple's growth has fallen to even negative in some recent years. Growth matures, companies go through life cycles, and good management of a company could be lured away to other companies. Now, why does the bad company get better? Well, if they're a bad company, they have low ROE, shareholders are going to have a lot of pressure on the company to fix themselves because they're a bad company and the stock's been floundering. Shareholders are not happy. So if they restructure, reorganize, introduce new products, they may get better, which means growth will be higher and the stock could go up. Bad management can be replaced. Low growth could be just there because you're an energy company and oil prices are low. If oil prices go up, growth goes higher, cycle rebounds, the stocks can do well. So there's a lot of pressures for reversion to the mean. High growth often slows, and the bad company sometimes actually gets better. And as growth slows, the good company, if it's overvalued, may underperform. And as growth accelerates, the bad company, which is cheap, may do very well. I've told you the problems with the single stage, constant growth, dividend model, okay? The Gordon growth model. Given you a lot of problems with that. One solution I said is use free cash flow instead of dividends, but we still have the problem with small changes in estimates, moving that model, valuation quite a bit, and some other issues. So now I need to give you a solution to our problems. So instead of using that model, use multiples in order to determine valuation. So remember, earnings times PE is price. Use the PE and you multiply it by earnings to get price. This is a much better, more stable model, and it's also theoretically sound because this PE model actually comes from the Gordon growth model. Let me show you. So what determines PE? Oh, even before I show you how we can create the PE from the Gordon growth model, let me give you a warning. What determines PE? Remember, PE is just price per dollar earned. Higher is more expensive. We always want to pay a lower PE. You may have a high PE for a stock because times are great, but you don't want to pay a higher PE. You always want to pay a lower price and get more earnings. I've seen people over time screen for high PE companies because you want to have a good company. Well, screen for the good companies and then do a secondary screen trying to actually find good companies that are cheap because you always want to pay a lower price and get more. So what determines PE? Well, the PE ratio is derived from the Gordon growth model, so it's theoretically sound. So remember the Gordon growth model, value of price equals dividends over the last 12 months times 1 plus the growth rate, which gives you dividends in year 1, over the cost of equity capital minus growth rate. This dividends D0 is just earnings times the payout ratio. The payout ratio is dividends per share over earnings per share. So earnings times dividends divided by earnings just gives you dividends. If I substitute earnings and payout into this equation, I get this equation. So then price equals earnings times the payout ratio substituted for D0 times 1 plus the growth rate over K minus G. The neat thing about this equation is I can divide both sides of this equation by the same number. If that same number is PE, the left becomes price divided by earnings, and the right becomes earnings divided by earnings, which is 1, so that just drops out of the equation. So the right-hand side just says PE is driven by the payout ratio times 1 plus the growth rate over the cost of equity capital minus the growth rate. Now, these things are in red and green for a reason. The reason is if you have higher risk, higher beta, your cost of equity is going to be higher, and that's going to drive down the PE. So high risk means price per earnings is lower. If you have high growth, you're going to get a higher PE. Growth is subtracted here from the denominator. So if the growth is higher, this equation becomes smaller. Anything on the top divided by smaller makes the left-hand side of the equation bigger. And of course, growth on the numerator is a plus. So higher growth drives up PE. Also, a higher payout ratio drives up PE. Now that's assuming everything is equal. And if you think about it, if you get more dividends as a percent of earnings today, that means you get lots of dividends today. It's discounted at 1 plus K to a lower power. If your dividends occur 3 years in the future, you actually have to divide 1 plus K to the third power. If your dividends are more early, it's 1 plus K to the 1 power if it's all in year 1. So the higher the payout ratio, the more dividends you get right away, should drive up the PE, assuming all else equal. Problem is not all else is equal. If you have a high payout ratio, you're paying out a lot of dividends as a percent of earnings. It's probably because you don't have a lot of reinvestment opportunities. And if you don't have a lot of reinvestment opportunities, your growth rate is going to be low. And if your growth rate's low, so G is low, that drives down the PE. And it turns out the impact of the growth rate is more important than the impact of the payout ratio. So high payout ratio companies, which are utility companies, tend to have a lower PE because they have lower growth. They also have at lower risk. Turns out the market tends to like to focus on growth more than risk. Let me give you just kind of an everyday example to help you understand that if you have higher growth and lower risk, you're going to have a higher PE. You're going to be willing to pay up for those earnings if they don't have much risk and they have a lot of growth. Here's my example. The price per car or earnings depends on, well, the price people pay for the car is higher for which car? A fast car or a slow car? Which one would you pay a higher price? Probably the fast car. A reliable car versus an unreliable car. Which would you pay a higher price for that car? Again, price per car, price is the X, the car is the Y. It's just like PE, price is on the numerator and earnings is in the denominator. So I probably will pay up for the fast and reliable car a higher price, just like earnings. If earnings growth is quicker, a higher speed, like this car, I'm going to pay a higher price for those earnings. So I'm going to have earnings in the future are going to be really high. If the earnings are very reliable, they're low risk. These earnings aren't going to go away. I can be counted on them year in, year out. I'm going to pay a higher price for them, just like I would pay a higher price for the reliable car. So it makes sense in theory, the PE ratio. derived from the Gordon growth model, but it also makes sense in practice. I'm going to pay up higher PE for reliable earnings that are growing quickly. A comment on great stocks. Great stocks tend to have accelerating fundamentals where things are getting better. So if your earnings are going from 5% growth to 8% growth, you would expect, first of all, you have higher growth. Remember, price is earnings times PE. So your earnings are going up quicker, so you're going to have higher price return. But also, if your growth rate is going from 5% to 8%, so it's accelerating, you're going to get a higher PE, assuming people expect that growth to last forever. Remember, if I have an 8% growth instead of 5% growth, this becomes smaller, which makes the PE go up. So PE expands if you have accelerating growth. Also, you want to have companies that are beating the numbers. If they're beating the numbers, it basically means you have positive surprise. And so stocks will go up. And if they have positive surprise, it could be because growth is greater. And if that's the case, it will drive up earnings growth, which is part of the price equation, and it's going to drive up PE. You also want to just have companies that are growing. So great stocks will more likely be growing. Finally, you want to have companies that have low expectations relative to what they're delivering. If you keep your expectations low, you'll never be disappointed. How do we actually figure out if there's low expectations? Expectations are quantified by PE. Remember, PE reflects people's expectations for payout, growth, and risk. I just showed you the equation. These four things I learned through my career that most great stocks, if you have a few of your horizon, possess. So keep that in mind. Let's look at Kohl's and how their stock has worked out using our equation for returns. Now remember, price equals earnings times PE. Price change is just 1+% change in PE times 1+% change in earnings minus 1. This is what we say it is. Let me now give you an example from 2016 to show you that exactly this equation works to show what happened to Kohl's stock. So in 2016, Kohl's stocks went from 47.63 last day of 15 to 47.98 the last day of 2016. It was up 3.7%. This is the line here, okay? So it's up slightly over that period of time, 3.7%. Over that period of time, the PE rose from 12.68 to 15.12. Here's the line. Or it went up 19%. Now earnings went down from 376 to 326 by the end of the year. Earnings went down 13.3%. Plug in these things into my equations, 1.192 times 1 minus the 0.133, subtract 1, you get the 3.7%, which is exactly what I said the price return was up. If there's any differences when you actually do the math, if you check the math on your own, it's just do the rounding of the PE and the earnings. What I told you works for a stock, forecasting earnings and PE to figure out price return does work for the stock. I have a question down here. Why has the PE risen? Over this period of time, why did PE actually go from 12.68 to 15.12? Well, earnings went down. Didn't we just talk about earlier that if you have high earnings growth, that the PE should go up, and if you have low earnings growth, the PE should go down? Well, in this particular case, PE rose while earnings growth went down. What the heck is going on? You say, Coach, you told me this, but it's wrong. Remember something. Why did the PE go up? Price reflects not what happened in the past. Price reflects what people expect happens in the future. So if earnings went down and the PE went up, that probably means that investors expect earnings to be better in the future. And what you need to think of if you're investing in Kohl's at the end of 16 is that's what the market's pricing in, that earnings probably growth will go up or risk is lower, the payout ratio is going to be higher. You have to figure out, because this has a higher PE than it had to start at year, do you agree with the market? Because the PE is telling you what the market expects. If you thought at the end of 16 that growth is not going to accelerate, risk is going to actually go up, the PE is higher, which reflects that risk is going down, growth is going up, you would say, hey, I don't want to be in the stock. Or you may say, I want to short the stock. You may also say that I agree with the market that earnings are going to go up by a certain amount and risk is going to come down, and that PE is well deserved, and you still may not want to buy it. Why? Because the PE is already up, reflecting that better environment. However, you could actually say that the environment's even going to improve more than the market thinks. Yes, I'm paying a higher PE at the end of 16 than the beginning of 16, but it doesn't fully reflect the improvement that's going to happen, and therefore it's a buy. These are the ways you can actually use these relationships to make a decision. Now, there's other multiples that we can look at. I talked about PE, but there's also price to book multiples, price to sales multiples. You may actually see there's additional multiples to these. These are the ones we're going to focus on in these slides. All these other multiples, price to book and price to sales, also fall out of this single stage, constant growth, Gordon growth model. So I showed you earlier, this is the single stage Gordon growth model. If you divide both, if you substitute earnings and payout for dividends, you get this equation A. If you divide both sides of equation A by earnings, you get the PE equation that we showed earlier, but I can also take equation A and divide it by book value per share. Now, what is book value per share? Book value per share is just the equity on the balance sheet divided by number of shares. It's what the investors have reinvested in the company and initial investment in the company. Price to book, then if I divide both sides of the equation by book, the right-hand side, price to book is driven by the payout, 1 plus G, R minus G, and this time I used R instead of K. Sometimes people use R to denote cost of capital, sometimes they use K, sometimes they use other things. So this is the same cost equity capital we actually used earlier, which I used the K symbol. This is the same part of the equation as actually we have up here for PE, except I have one more part of the equation that's not in the PE equation, and it's earnings divided by book value per share. Earnings divided by book value per share is just ROE. So higher ROE drives up price to book. I can also take equation A, instead of dividing by book, just divide it by sales. The left is price to sales, the right is earnings divided by sales, same thing here as before. Earnings divided by sales is just profit margin. So profit margin drives price to sales. So if we just look at this, doing the same analysis I did with PE earlier, price to book has a positive relationship with ROE. This makes sense. If I have more income per dollar of equity invested, which means I have a higher ROE, I should be willing to pay a higher price per dollar of equity invested because I'm making more income. Price to sales ratio is also higher if profit margin is higher. If I'm making more income per dollar of sales, I should be willing to pay a higher price per dollar of sales because it's more valuable, it's making me more income. So theory says price to book should be higher with a higher ROE, price to sales should be higher with a higher net profit margin. Let's now go from theory and look at, in practice, what we actually see, and let's build out showing you that risk is lower, drives up PE, which would also drive up price to book and price to sales. Let's also look to see if higher growth drives up PE, higher ROE drives up higher price to book, and higher profit margin drives up price to sales. Let me show you the actual data. So first, let's look at risk. So PE should be higher if risk is lower, and PE should be lower if risk is higher. So a friend of mine, Tobias Lefkovich, a Citigroup, calculated K, or the cost of equity capital, for the S&P 500, so the stock market, by looking at the 10-year treasury, and he had a way of actually calculating equity risk premium of the market. 10-year treasury plus the risk premium is K. What he actually shows here is that as a K goes down, so the risk goes down, the PE goes up. And as the risk goes up, the PE comes down. He shows this as a linear relationship. R squared is 0.68, so it's a pretty good relationship. But you actually see here that the relationship is not linear, it's exponential. The reason why the relationship between K and PE is exponential goes back to our initial equations I showed you. Recall, earlier on in the slides, I said value equals free cash flow in year 1 divided by 1 plus K to the 1 power, plus free cash flow in year 2 divided by 1 plus K squared, plus free cash flow in year 3 divided by 1 plus K to the 3rd power. These are to the powers. When you're discounting it by 1 plus K, it's always to the power of the year. It's not multiplied by 1, it's to a power. This power means it's an exponential relationship between K and value, or in this case, K and PE. So as K goes down, since it's an exponential relationship, PE rises at a quicker pace. As K goes up, PE falls, but at a slower pace. So this is kind of a, it's not a linear, it's kind of curved model. Another way of looking at risk comes from another very good strategist from ISI Group, Dennis. He actually looks at risk, and he quantifies risk here by looking at the Consumer Confidence Index. So if consumers are more confident, they believe risk is lower. If consumers are more confident and risk is lower, that drives up the PE. And if consumers are less confident, they believe risk is higher, that drives down PE. Exactly what our theory says. Now let's look at a couple other studies to see if PE is related with growth, price to book is related with ROE, and price to sales is related to net margin. Two different authors, Jared Wilcox did a price to book ROE model, and this paper was in the 1980s. Valuation Securities, I believe this was their strategist. This firm is no longer around. He looked at the relationship between price to sales and net profit margin. Let's look at the results. PE is positively related to growth based on Wilcox. Now, he really worked at this. He had some way to smooth out earnings growth, which is on the x-axis, and PEs on the y-axis. As you can see, there's somewhat of a positive relationship, but there's a lot of variability in here. He also looked at price to book on the y-axis to ROE on the x-axis, and you can see there's a positive relationship. These are some of our notes as we're thinking about building out a model with this, but it's tighter. Valuation Securities looked at price to sales and net profit margin, and again, there's a positive relationship, and this is a tighter relationship, just like price to book and ROE is, than the PE and growth. Why is there less correlation between PE and earnings growth than there is between price to book and ROE and price to sales and net profit margin? Just think about that for a second, and I'll give you some hypotheses. Now, one reason you could say is that this earnings growth may reflect just 1 year. I believe I'd have to go back to the study to confirm this, but he looked at a smooth earnings growth, so he wasn't just looking at 1 year. And price to earnings reflects the growth of earnings in all future years, so just looking at 1 year would not be necessarily adequate. That could be one reason, but I believe you tried to account for that in here. Another reason is earnings. So there's a quote that I'm quoting other people. Cash is an opinion, earnings are an opinion. There's so many things a corporation can do in order to pump up earnings that the earnings number may not reflect the true earnings power of the company. As a result, the market will look through maybe that earnings number and it doesn't have as tight of a relationship. Regardless, people tend to really focus on PE and earnings, and I am in my slides here just because that's the starting point, but I want to point out to you also that you don't want to ignore price to book and ROE or price to sales and margin, because these relationships are even more robust than PE and earnings growth. That could be your opportunity to focus on these, even though they're less popular. Now, those studies that I just showed you in 80s and maybe late 1990s, mid 1990s, that's old data. So I wanted to actually redo this study, which you saw in the prior slide, with more recent data. So this data for the S&P 500 and 400 comes from earlier this year, early 2018. And I wanted to see if PE is positively rated for growth for these securities. Now, it's not all 900 securities because there's some NAs that are involved in there. I tried really hard to figure out a relationship between PE and growth. I used sales growth because sales growth is maybe less volatile than earnings growth. I use price to average earnings over 6 years, price divided by an expected earnings. I used all kinds of different things to try to find this positive relationship, and you can see I wasn't too successful. Even down here, I used a PE and the consensus long-term growth rates based on analysts. Again, there's a lot of variation. Price to book and ROE seem to be a little bit tighter relationship, and price to sales and profit margin also seem to be a little bit tighter relationship than PE and growth. Same thing we saw with those earlier studies. Now, there's one thing I want to point out in here. You'll say, well, this valuation forming up with the financial success is not so good, but remember, there's more that impacts price to book than ROE. There's more that impacts PE than just growth. There's more that impacts price to sales than just net profit margin. Let's go back to our equation. We have ignored growth and risk and payout. If we're looking at price to book, same with price to sales. If we're looking at the PE, we have ignored, well, I looked at PE and growth, I've ignored the cost of equity and the payout. So I'm only including one variable in those scatter plots. If we included all the variables, maybe this relationship would be even tighter. The other way we can actually do this, instead of looking at all the stocks together, we can just look at the stocks within a sector. If you look at the stocks within the sector, then some of the variation in the risk profiles will be gone, because most stocks in each sector have similar betas. They may have different risk still profiles, but they're generally, if an industry has a beta greater than 1, most companies will be more risky than the market. Here I'm lumping the high risk companies with the low risk companies. If I only lumped similar companies with similar risk, then this price to sales and margin relationship even becomes tighter, and the price to book and ROE even becomes tighter. You really can use this to start figuring out what multiples you pay for a stock. I told you PE times EE is price. Well, price to sales times sales is price. Price to book times forecast of book is also price. You can forecast price to book if you know the ROE and the relationship between price to book and ROE. You can do the same for price to sales. You can forecast price to sales if you know where net margin is going to go and the relationship between price to sales and margin. Let me give you a couple other thoughts on PE, and then we're actually going to look at a real example of using this PE and growth, price to book ROE, and price to sales and margin equation. So what determines PE? I already gave you the theoretical ways to come up with what drives PE, but you may also want to consider historical PEs when you're trying to figure out the proper PE is. Because if you're trying to forecast the price of a stock, you can forecast earnings and you got to forecast what PE ratio to multiply those earnings by. You can use the theoretical equation and kind of come up with what PE it should be. So I can come up with the PE I should have in the PE times E equation using this. But remember, this equation, just like the Gordon growth model, is extremely susceptible to small changes in your assumptions. So if you just use this equation to come up with the PE, I would say it's problematic because I've changed K and G a little bit and I can get a much different PE. So another way to come up with what PE you should use if you're trying to forecast price using PE times earnings, consider the historical PEs of the company. Here's an example. Let's say Kroger has a PE of 15 and you see its 5-year average is 20. Well, you say, well, Kroger is cheaper than its 5-year average, so it should go back to its 5-year average, and I should be paying a 20 instead of 15. A warning. This lower than average versus history PE may be justified if Kroger in the future versus the past 5 years expected to have a higher risk, a lower payout, or a lower growth in the future than the past. So you can use the past as a guide to what PE to use, but remember companies change over time. You can also consider the competitor's PE. So what I always did is I had a spreadsheet, a real spreadsheet, where I downloaded or inputted manually the PEs of every company and their competitors. I also inputted their growth rates, their ROE, all kinds of other statistics that may drive PE. And I would compare the PE of the company I'm looking at to its competitors because they should have somewhat similar PEs in the group. So let's say the PE of Kroger is less than the PE of Safeway. You could then say Kroger is the buy and the Safeway is the sell because you always want to pay less PE than more, with a warning. Kroger's PE could be lower than its competitor PE if Kroger has a lower ROE, lower growth, lower payout, and higher risk than Safeway. So a way to start, a starting point to figure out what PE to use is consider the competitors, consider the history, but also consider that the environments can change over time and every company and sector or industry doesn't deserve the same PE because they're different companies. Another warning, a company could have a lower PE than its history, a lower PE than its competitors, and be overvalued. So what if your company has a PE of 15 and the competitors have 20? How could it be overvalued? Because it's at a 15 PE versus the competitors at 20. Well, what if the market got it wrong? The reason why it's at 15 versus 20 is because the market thinks growth is lower and or risk is higher. And maybe the market got it wrong because growth is much, much lower and risk is much, much higher. And they haven't accounted for that. And the P, instead of 15 versus the competitors at 20, it should be 10. So a PE that's lower than average does not necessarily mean it's undervalued. Likewise, a PE higher than average does not mean it's overvalued. If the competitors are at 20 and the PE of the company you're looking at is 25, 25 could be too low. It reflects that the market thinks that this company is better than the competitors, but 25 could be too low if they have a huge growth advantage and that growth is certain, so risk is low. So maybe it deserves a 30 PE. So you can use competitors and historical PEs as a starting point, but just don't say a company with a high PE is overvalued or a company with a low PE is undervalued. It may be, but it may not be. You have to figure that out. Let's look at Kohl's again. Let's look at some history of Kohl's. So is the PE cheap, expensive, or just right? Is the stock undervalued? Is the stock overvalued? Or is it priced just right? You remember the story of the little bears. Is it too soft? Is it too hard? Or is it just right? This is the graph of the PE over time, which has come down, and this is the earnings over time, which have gone up. Earnings have recently rebounded, but the PE has come down. PE sometimes varies inversely with earnings. Why is that? Why does this PE come down when earnings go up? You see here, PE went down, earnings went up. PE goes up. All right. Actually, yep. Let me actually think about this. So yeah, you have an inverse relationship. Well, when PE is high here and earnings are low, the reason why the PE is high, remember, price reflects what happens in the future. So if earnings are low, they're going higher here. So the PE accurately reflected this great growth. After this great growth, PE came down. Well, look what happened to earnings. They were flat. Now PE is low and earnings are high. This probably tells you that the market's thinking this great growth is not going to last because we're not going to actually pay up a really high multiple for it. That is for what the market's saying. What you have to say is, do you agree with that? If you believe growth is going to continue to be high and the company is really fits the problems, is dealing with Amazon and online sales, has a really good capital budget, and is thinking things through, well, the market's saying that that's not going to last, and this could be a buying opportunity for you. Or you could say the market's right, and this deserves a low PE and move on. It's up for you to decide, but the market's telling you something, and you need to look at the business, look at the industry, look at the financial success of Kohl's or their not success, and figure out whether the valuation is reasonable. How do we calculate a target price with PE? I've already alluded to this in past. Determine the appropriate PE. It could be based on history, it could be based on comps. Determine the earnings forecasts, and then multiply the two together. So if I say this is a PE of above 12, let's say the 12 PE is what I think, I don't think this, but let's just say I think this, that the PE should be 12 at the end of 2009, so 12 times latest 12 months earnings, PE. So this is price over the latest 12 months earnings, but the latest 12 months earnings at the end of 2019 is 2019 earnings. So I take 12 times 2019 earnings estimate, which I have here is 529, which is what I looked up as the consensus. I believe I looked this up as the consensus estimates by analysts in 2019. That would give me a $63.48 target price at the end of 19. Be aware, valuation is not an exact science, so please round your numbers. No one gives a target price to a decimal like this. So let's say the value of the security at the end of a 19 based on PE times earnings is 63. And then you would compare that value to the current price. Now, if you wanted to actually forecast what the price should have been at the beginning of the year, you'd have to take this end of the year value and divide it by 1 plus k to the 1 power. Now, we're sitting here with more than half of the year over. So I would take 63.48 to 1 plus K to about a third of the year or so left, a little bit more than that, power. And that would give you back to the price to today, which is middle of August. Okay, let's move on. So I gave you examples of PE and growth, price to book and ROE, price to sales and net margin for the overall market. I told you also that these relationships tend to be tighter if you're looking at like companies and like sectors. So what I have done is I've looked at Kohl's versus other comparable companies, their PE and their growth rates. I also looked at price to book and ROE and price to sales and net margin. And I've created some graphs for you. First of all, PE is related to growth. I've tried really hard. I could have used 17 growth, 18 growth, consensus growth, and I tried really hard to give you a relationship where you had a R squared that was reasonably high. Keep in mind that this could be an outlier, and if I only use these 5 points, I may even have a lower R squared. And already you can see I'm using less securities here than I used here, more than likely because I eliminated some other outliers. So PE is weakly positively related to growth, but price to book is very much related to ROE, 0.94. Price to sales is very much related to net profit margin. If I can forecast the ROE of Kohl's, which by the way is, I believe, Kohl's, what is this point right here, 1.96, a 13% ROE. If I can forecast ROE of the company in the future, I can use this equation to determine what price to book to pay. If I can figure out what price to book to pay, I can multiply that by book value per share, which I probably actually forecast to get ROE. Price to book times book value per share equals price. Forecast the fundamentals, and you can forecast the multiple. I'm going to give you some examples of this. So using price to book and ROE, the same graph we had before, this 1.96 at the moment is slightly above this line, this best fit line. What multiple price to book should I pay using the competitors and this relationship? Well, I can come up with a target price to book by saying 20.599, price to book is the Y here, 20.599 times X, well, that's ROE, 20.599 times Kohl's ROE of 13%, subtract out the intercept, and you come up with, they should be trading at a 1.76 price to book, which is 10.1% lower than the current 1.96. So what is the target price? Well, the price at the time I did this was $63.19. Subtract off 10.1% from that, and you get a target of 57 using this model, using the relationship between price to book and the peers. There's another way you could do this. You could take 1.76 times the book value per share of Kohl's. You get the same 56.78. Now this is to get the current price, the value today. If I'm trying to forecast a price 1 year out, you determine the appropriate price to book from this equation using the forecasted ROE and plug it in for X, and then multiply the forecast ROE by 20.599, subtract out the intercept. You get to the price to book target, and then you would multiply that by the forecasted book value per share, and that gives you a forecasted target price 1 year out. Caution. You need to run some scenario analysis. If you're doing things at a one point in time, remember ROE for the company can change. If the ROE goes up, the stock may go from overvalued at the current situation to undervalued. Also, you have to be aware that the relationship between price to book and ROE can change over time. So the slope can change, the curve can shift up or down. A time period where the slope may become higher would be like in a crisis situation. In a crisis situation, companies that can maintain a higher ROE become more valued. The ones that are just floundering may not even survive. They may be pushed down, price could go down. In a crisis or recession, you may see a steepening of this line and also see, since the whole market's probably down during a period of time, not only do you see a steepening, but the line could actually move downward. So you could have a line like here. So don't just use this equation blindly to figure out what price to book to pay. You have to think about conditions can change. And you could always look at what's happened in the past. This is a snapshot at the point of time I actually did the model. You can actually do this 3 years ago. If you did it 3 years ago, you'd be able to see the relationship then, and if this relationship is stayed the same or has changed. And then you make up your mind which relationship makes sense to you going forward. Let's change our attention and look at Nike, and then we're going to look at Nike versus Kohl's and try to come up with some solutions. Earlier today, I actually said I gave you a few rules on what makes a great stock. Accelerating fundamentals, beating expectations, solid growth, and low expectations. So is Nike a great stock? Early 2018. Well, in early 2018, this is the price of Nike over time, the black line. This is at the sales per share over the latest 12 months, which is growing nicely. This is the sales forecast in the future, which is growing nicely. So you have good growth, and revisions continue to be good here for sales. Looking at earnings, same thing, but with earnings, you can see earnings have kind of weakened a little bit recently. Still have some solid growth in sales, but earnings have weakened recently, and the forecasted earnings have also somewhat flattened out. The company is still positively surprising when they're producing earnings at the quarter. So all these numbers are positive. And the price impact, generally when the company reports positive surprises over the last couple of years, the stock has gone up. So you have some positive surprise beating expectations, but I wouldn't say they have low expectations overall. The PE of the company, PE's on the left axis, the PE of the company at the time I did this, which was early 2018, was around 29. 29 is high. It's much higher than the market. It's much higher than Kohl's. So let's look at Nike versus Kohl's. So early this year, Nike had a PE of 27.2 versus Kohl's at 17.4. Nike's PE was 50% higher than Kohl's. What did that imply? We know that must have implied that people expect Nike to have better growth than Kohl's. Could have implied they also think Nike's risk is lower than Kohl's, or it could have a higher payout. Turns out it's not the payout because payout of Nike is lower. Let's work out the math though, assuming the reason the market's willing to pay a 27 versus 17.4 because they believe Nike has better growth than Kohl's. Let me look at some market data. At the time, the price of the two companies were about the same. The PE of Nike, again, is 27.16. Kohl's is 17.36. The return on equity of Nike is really high, basically 33% versus 13%. Remember I said these extra decimals, those are just rounding. So let's say it's 13 versus 33. So Nike is much more profitable per dollar of equity invested than Kohl's. If you recall from maybe other classes, other things you read and learned yourself, ROE times the retention ratio Retention ratio is just 1 minus the dividend payout ratio. It's the theoretical growth rate over the long term. Kohl's pays out over half of their earnings in dividends, where Nike only pays out less than a quarter of their earnings and dividends. Nike's reinvesting way more in the company, probably to grow, where Kohl's realize their growth is mature, their company's mature, and they're paying out way more in dividends. They're not reinvesting as much for growth. And actually, they're paying out with the other part, a lot of that is ending up being share buybacks. If you use the theoretical equation for growth rate, you take ROE times 1 minus the payout, which is also the retention, you get to 24% long-term growth rate for Nike and 6.2% long-term growth rate for Kohl's, so an 18% advantage. This theoretical growth rate doesn't work in practice. I have in the appendix, which is on coach investing, why that's the case, what assumptions underlying that. It's in the appendix to these slides. But the assumption is if you reinvest money, you can get to this 24% growth if you reinvest and you make 33% on any reinvestment. It's very hard for a company that has a high ROE to reinvest and earn the same ROE. If you do, you get to here. If you don't, you get to something less than here if you earn less on the reinvestment than your existing ROE. But anyway, 18% advantage. This really much higher ROE is also driven up the price to book of Nike 9.1 versus Kohl's at 2.2. Let's assume in my equations here, let's just eliminate risk from being what's driving these differences and just assume the same risk. Now, 18% higher theoretical growth matches up pretty well with what happened over the last 5 years. Earnings per share for Nike have been up 16.8% per year over the last 5 years versus Kohl's down 2.3, about 19% difference. Now, Kohl's net income was actually down much more. It was down like 14%. How did it get to the minus 2.3? They're buying back shares. Kohl's sales were flattish over that period of time, but their sales per share were up about 9%, 8%. Nike's also buying back shares. They're just buying back way less shares because they're reinvesting way more of their company into the business. So this is our starting point. What I want to do with you is figure out how many years does Nike have to grow at about 18% more than Kohl's to justify this 50% approximately premium PE. Nike's had better past growth. Kohl's is a good allocator of capital. The math works out to, all else equal, including discount rates and things like that, Nike has to grow 18% faster than Kohl's for the next 14 years to justify this premium. It's possible, but maybe it's not. Let me show you the math. Let's say you have $1,000 you can invest in both companies. Well, $1,000 in Kohl's and the PE ratio is 17.36, so price divided by earnings. So you take 1,000 divided by the PE, and that tells you how much earnings you have in year one, 58. Do the same for Nike. 1,000 divided by 27.16, they start with 37 in earnings. So Kohl's has an advantage in the beginning. They're getting more of their earnings early, and earnings, remember, can be used to pay dividends. So you're getting more of your dividends early with Kohl's than Nike. How many years, with Kohl's growing at 6% and Nike growing at 24%, does it take for earnings of, basically the earnings that are coming through to the investors for them to be equal? About 4 years. But I said it takes 14 years to justify Nike's premium valuation. Remember, it's just not earnings in that 1 year that matter, it's the cumulative earnings power. So the first year, the cumulative earnings for Kohl's is 58. After 1 year, it's 58 plus 61, 119. And you do the same for Nike. It takes 6 years for them to have the same cumulative earnings. But wait a second. The value of the security is not the discounted cumulative earnings, it's the discounted dividends. So we care about dividends. Well, if you start with 58 in earnings for Kohl's the first year and you pay out 52% of that in dividends, the first year dividend for Kohl's is 30. You do the same thing with the 37 for Nike, but you're only paying out 20%, 28% of that in dividends. You start out with 10. It's a 3 times advantage that the Kohl's shareholder has over Nike in year one. It takes 8 years for Nike, growing 24%, Kohl's 6%, to catch up. And that's just to catch up. So the dividends are the same in that 1 year. How many years does it actually take for the cumulative dividends of Kohl's and Nike to be the same? 12 years. But remember, dividends in the future need to be discounted back to today, because dividends today could be used to invest and you have more dividends in the future. So these dividends that we're getting all the time need to be discounted back today. So how many years does it take for the cumulative discounted dividends of Kohl's and Nike to be the same? 14 years. It takes 14 years to just justify a 27 PE. Go now and look up what the PEs are of the FANG stocks. You're going to see, except for probably Apple, they're much, much higher than 27. They're pricing in huge advantages in growth, which could happen, but it may not. You have to know what you're paying when you buy those stocks if you're a holder of them for long term, because over the long term, valuation probably does matter. Even in short term, it does matter as well, but not maybe for the next 3-6 months. Momentum can drive markets to extremes. Now, this is actually an unfair example, because remember, this only includes dividends. And Kohl's is buying back a huge portion of shares and way more than Nike. In order to figure out the total distributions on a discounted basis of Nike and Kohl's, it's way more than 14 years. Earlier in this presentation, I talked about how long does above average growth last. Do you remember what I said? About 4 years, you have a lot of the reversion. I mean, by 10 years, the high growth and the slow grower are about the same. I'm not saying that Nike and Kohl's will revert to the same growth over a decade, but I am saying that the average company does, and you need to be aware of that. And this relationship we see between these two stocks prices in pretty high expectations for Nike relative to Kohl's. And you need to be aware of that if you want to be an astute, good long-term investor. One more example for you using multiples. And this time I'm actually going to look at a sector, because you may want to do more than just pick stocks within industries. You may want to figure out what sectors to buy. And this time I'm going to look at the consumer staples sector. And I'm going to look at a relative value, so using relative multiples, and also use a history of it. What you have here is the S&P 500 PE over time. And you have in blue the consumer staples PE over time. Consumer staples includes like food, beverages, household product companies, very stable companies. You'll probably buy food even if you lose your job, okay? And that's what they sell. Recently, the PE of the consumer staples has really fallen relative to the market. To get a relative PE and a history of it, I just take the blue line divided by the black line, and I get this blue line down on this chart. I overlaid on this blue line in this chart the economy, the ISM PMI, which we talked about earlier, and you see there's an inverse relationship. Before we get to that, let me say a little bit more about this relative PE. So I take this blue divided by the black, and you see that the relative PE of consumer staples right now is trading at 80% or 0.8 of the PE of the market. Historically, it's traded at an average about closer to 1. Now, this group probably has lower growth in the market over time, but since it's a very stable business versus other cyclical businesses, its risk is also lower. So lower risk means a higher PE, but lower growth means a lower PE. They somewhat have offset over the history, and the sector's gotten about a 1 multiple. Right now, it's trading very low, but it tends to trade very well when the economy is strong and doing well. When the economy is strong and doing well, people don't care about these boring safe stocks. They rotate into other stocks. So staples tends to underperform and it becomes cheaper. We can also look at just the returns. We know PE is a part of returns. It's PE times earnings equals returns. So over here, I actually look at the consumer staples annual return minus the market's annual return. So it's a relative return. So if this relative return is going higher, staples is outperforming. When does staples outperform? When the economy is bad, lower than 50, and getting worse. Economy is strong and getting better, staples underperforms. So there's an inverse relationship, and this inverse relationship in the price and even the valuation is determined by this economic driver. But there's also other drivers that could be influencing consumer staples. If you look at the CPI of food and beverage versus its PPI of food and beverage, so the cost to produce versus what they actually charge to consumers, that's this black line. So here they were charging very high prices and price growth to consumers relative to their input costs, which weren't rising as quickly, and the stock did well. Recently, the CPI of food and beverage has not kept up, or slowed the advantage versus PPI, and the stocks have underperformed. It's starting to turn around. It's starting to turn around. And if that's the case, then your revenues will be rising quicker than your costs, and that could help out profits. Let's look at the PMI. The PMI is very high here, 60, 60, 60. If you go back in history, the PMI staying at this level and going higher, it really doesn't happen very often. So what's more likely to happen? If the PMI is high, the economy is strong, what will the Fed do? Maybe raise interest rates. They're raising interest rates right now. And they're doing that to slow the economy, to make sure that you have, not too high of inflation. So if this comes down, what will happen to the stocks normally? Doesn't always happen. It could go up. So the stocks have been hammered because the economy has been strong. They've also had the CPI, PPI thing, and there's some other things maybe going on as well. Coca-Cola and Pepsi are big companies in this sector, and they have lots of soft drinks. And guess what's happening? People are not drinking soft drinks quite as much, and they're moving to other beverages, water, and things like that. So that could also slow growth and been also a negative driver for the group. This again gives you a framework at how to use multiples, and for a sector, a relative multiple, but comparing those multiples to history, it shows right now that the stocks are pretty cheap. And they're cheap for a reason, but the reason could change in the future. So finally, some takeaways for the row. Valuation, first of all, is an art, not a science. Hopefully, I've shown you here that there's many different ways to value securities. There's not one precise value, and there's a lot of assumptions that go into it. Price does not necessarily equal value, and where is different from value is your opportunity. Be wary of those high growth estimates. High growth does not tend to last as long as people think. And remember, markets can be wrong. That's it for the presentation, but let me also talk about what's in the appendices because I posted these on Coach Investing. I told you earlier that ROE times the retention ratio does not necessarily equal growth. I have a slide showing you that. Higher margin firms should have higher PE, all else equal. I give you an example where all else is not equal. Many of you may be used to using a discounted cash flow model We have a terminal value based on that single stage, constant stage Gordon growth model. I give you a different example using that terminal value derived from a PE. We talk about figuring out what implied growth rate is from valuation. We also talk about companies in these slides can create earnings but destroy value. If they create earnings by growing the business and they earn an ROE less than their cost of capital, that actually destroys value but can create earnings. I'll give you a longer relationship of PE earnings and S&P returns. Another example of relative valuation history. My example of what is required to justify a 50 PE, and I give you a framework for thinking about valuation models and specific uses of different multiples over time, and even in what sectors and conditions of companies to basically use these multiples for. That's it for this presentation. I wish you a great day and excellent investing success. Have a great day.